We will now discuss the solution to problem 8-21, which requires us to prepare a schedule of expected cash collections and then a cash budget. Problem 8-21 talks about Natural Care Corporation, a distributor of natural cosmetics, that has requested a $60,000 90-day loan from the bank. The bank is concerned. This company's had some difficulty in the past, and in order to approve them for this loan, they want to see a cash budget for the third quarter, which includes the months of July, August, and September. They give us the actual sales for May and June, and budgeted sales for July, August, and September. Experience shows that 25% of the month's sales are collected in the month of sale, 70% in the month following, and 2% in the second month following the sale. Therefore, first things first, let's prepare a schedule of cash collections. Schedule of cash collections requires us to look on a month-by-month basis and determine how much cash we will receive in that particular month. For the month of July, we're obviously going to collect some portion of July sales, that being 25% of the $350,000 or $87,500. That's the obvious. We're also, since it takes us 3 months to collect all of the cash that we're going to collect from sales, we need to go back to the month of June and back to the month of May. May is 2 months prior, and when sales occurred in May, 25% would be collected in May, 70% in June, final 2% in July. So 2% of 360 is $7,200. For the month of June, all right, which is the month prior, when sales were derived in June, 25% of them were collected in June, and the next 70% are collected in July. 70% of $280,000, $196,000. So all told, when you look at the cash collections for the month of July, you have those from May, June, and July totaling $290,700. When we next go to the month of August, you'll notice that in August, we'll take care of the August sales first. $420,000 of sales in August, 25% of them collected in August, therefore $105,000. We then need to go back and look at July. Well, July sales, 70% of July sales collected in August, or $245,000. All right, there. And going back to the month of June, which is 2 months prior to August, we will collect the final 2% of those sales. Keep in mind, we're only collecting 97% of all sales. The other 3% are uncollectible. So 2% of 280 is $5,600. For the month of September, all right, we're going to collect that 25% of September sales, 25% being of 360 being $90,000. For August, we're going to collect 70% of the 420 or $294,000. We're then also going to collect the final 2% of July or $7,000. We add up each of the columns. We can also add across. All told, for the quarter, we'll collect $1,037,300. This is very important, the totals for each of the 3 months, because we will then drop this figure right into our cash budget. If you scroll down to the cash budget as I've done here, let's walk through the solution of the cash budget. Part 1 asks us to prepare the schedule of expected cash collections, which we just did. Part 2 asks us to prepare a cash budget. We're going to start with, in the month of July, our cash balance estimated in the problem is $43,000. Add to that our $297,000, all right, of collections that we calculated to be, or cash to be collected in July. And then pretty much the disbursements are as laid out in the problem. Right? There's a schedule for July, August, September. We use only a couple tricks. One is that merchandise purchases. We make the purchase of merchandise in 1 month and then pay for it the next month. So in the month of July, we are actually going to pay for merchandise we purchased in June. So in the book, they tell us that merchandise purchases in June that were paid in July total $160,000. Salaries and wages, advertising, and rent are given to us in the book, as so is the equipment purchases. Letter D there, equipment costing $25,000 is purchased for cash during July. The only other trick to note is depreciation for each of the months is $40,000. Depreciation is a non-cash charge, therefore not included in the cash budget. So at the end of the day, what we do is we add up our total cash available, which is beginning cash plus collection from customers, minus total disbursements, to give us an excess or deficiency, in this case a deficiency of receipts over disbursements, where we've spent more than what we've had available by the amount of $31,300. And that is the reason for the loan of $60,000, which we took out in July, or expect to take out in July, giving us an ending cash balance of $28,700. Looking further, the ending balance of 1 month becomes the beginning balance of the next month. So 28.7 is our balance at the end of July, becomes the beginning balance in August. To that, we add our collection from customers of $355,600. To give us cash available of $384,300. We then list out our disbursements, which once again, the only real trick here is that the merchandise purchases is the actual merchandise purchased in July, paid for in August, to the amount of $170,000. So total disbursements $360,000, subtracted from our cash available of $384,300, gives us an excess of receipts over disbursements of $24,300. Giving us an ending cash balance of $24,300. That becomes the beginning balance in September. Added to that is our cash collections of $391,000 that was found previously right here in our schedule of cash collections, giving us cash available of $415,300. Once again, we subtract merchandise purchases, salaries, advertising, rent. Total disbursements $350,000, leaving us an excess of receipts over disbursements of $65,300. We then subtract out first interest when we make debt service payments. The first amount of money is allocated to interest. They tell us $2,000 of interest will be paid in June. If we were to repay $60,000 of the total loan balance, we'd have total debt service or financing payments of $62,000. Leaving us with an ending cash balance of $3,300. Now, the book tells us that the bank requires to maintain a minimum balance of $20,000. Therefore, we will not be able to pay back the full $60,000. So, question or part 3 asks us whether or not we'll be able to maintain a minimum cash balance of $20,000 if we were to pay back the full loan which opened in September. And the answer is no. The last thing I would just make mention of is the quarter totals. You want to be careful if you're to calculate the quarter totals. The quarterly beginning balance is the beginning balance of the quarter. Well, the beginning month of the quarter is July, therefore the beginning cash balance, the balance that was for the quarter, is that which existed on July 1st. You will be able to add across the collection from customers. You will be able to come across and get the cash available. And you'll be able to add across for all of these items, for all the disbursements. You want to be careful. You want to subtract cash available less total disbursements to give you excess of $5,300 of receipts over disbursements. Drop in your financing coming straight across, and you'll find out that you have a cash balance ending of $3,300, which is in fact the ending cash balance for the month of September. This does it for our discussion of the solution to problem 8-21.